welcome everybody to today's webinar from PWL Capital. It's been a little while since we've done one of these, and so we're happy to be back. And the topic of discussion today is how much do you need to retire in Canada? I think for a lot of us, this is something that we think about a lot, and not a question that has necessarily an easy or obvious answer. And so our hope today is to take you through some content and some ideas that will help shed some more light on how you can think about answering this question for yourself. We'll get a couple of quick housekeeping items out of the way. So first, let me introduce myself. My name is Phil Briggs. I'm a senior wealth advisor and portfolio manager with PWL Capital. And my co-host today is Joel Barwick. Joel, do you want to say hi and introduce yourself?
Good afternoon, everybody. My name's Joel Barwick. I'm a wealth advisor and associate portfolio manager here at PWL Capital, and I'm joining the call from London, Ontario.
For those of you that have, and maybe you've attended past webinars, maybe this is your first time, we're using a presentation software today called Menti. And the idea behind this is that rather than Joel and I just talking at you for the next 45 minutes or so, we would actually love the opportunity, in addition to the chat, which so many of you are already chatting away in, we'd love to have some additional interaction with you through our presentation software. As we go through this slide deck, there are going to be some questions that are going to pop up on the screen, and we would love it if you could participate along with us and answer some of these questions as we go. And so to do that, you can log in to menti.com and either type in the activation code that you see on the screen there, or you can just simply scan the QR code, and that's going to bring you to this presentation live, where you'll be able to type in your answers on the screen. We find that we've gotten a lot of feedback on this, that this is a much more helpful and engaging way to do these kinds of presentations. I don't know about all of you, but just listening to somebody for 45 minutes straight can be a bit of a challenge. And so a little bit of back and forth, a little bit of interaction, hearing what you're thinking, hearing your perspective, I think will make this a little bit more fun as we go. So I'll give you 5 more seconds if you want to log into Menti and participate along with us. And just as a bit of a warm-up question and to get some of this crowd participation going, we'd love to hear your perspective on this question. If you could retire tomorrow, how do you think you would spend your time? We'd love to sort of hear what people are thinking. And I'm just going to read out some of these for anybody that maybe can't see it, or lots of travel, lots of volunteering, touring the world, relaxing, running.
Yeah, I wouldn't mind visiting Jeff in South Carolina there.
Yeah, exactly. On a beach somewhere warm, exactly. Run, play piano, volunteer. Awesome.
Golf, love to see that. Lots of golf.
Become a YouTuber and write a book. That's a good one too. Awesome. Well, we really appreciate everybody sharing your answers. One thing, I mean, I've been a financial planner for over a decade at this point, and I find that, I love having these discussions. I love doing retirement planning, but I would say that one of the most important things is not just thinking about the job that you want to retire from, but having a vision, having a dream of what is it that I'm retiring to. We all think about how much, we're all working nowadays, full-time job. That's a lot of time back into your schedule that needs to be filled up. And so having an idea of what you want to retire to in the future, I think is super important. And so love hearing some of these ideas from our audience about what you're dreaming about. Thanks so much for sharing that, everybody. So let's get into our agenda for today. We've got really 4 main topics that we want to present on. The first is where to start. So if this is, something that you've wondered about, how much you need to save for retirement, but don't even know where to get started, we're going to give you some thoughts around how you might frame this question and how to even get started in thinking and planning for it. Next, we're going to do an overview of the Canada Pension Plan and old age security. Again, in my experience, I find that these benefits that Canadians get from the government are often misunderstood, often misused. And so I'm hoping that we can provide some clarity on how these work, because for us as Canadians, these are really important pillars in our retirement plan. And we want to make sure that we're being strategic and using these optimally as we think about planning for our future. We're also going to talk about two of the biggest risks that you need to think about when it comes to a successful retirement plan. And then finally, we're going to walk through a bit of a case study, a bit of a sample financial plan at the end that talks about turning your savings into income and some of the things that you need to think about when it comes to that. Can we share the Menti code? Sure. I will go back. The Menti code is 32030666. So hopefully Daniel, yeah, oh, I see somebody typed it in. That's awesome. Oh, Daniel typed it in. Awesome. Thank you. And I also see the update 3-0 Canada. Thank you very much. So let's dive in. Joel is going to talk to you about where to start when it comes to planning for your retirement.
Awesome. Thank you, Phil. So, retirement for Canada really is the biggest financial goal that everyone works towards. And because this is such a big and important goal, it can also be intimidating to approach. So, it's really important when you're working towards any goal, let alone your retirement, to make sure you're focusing on the right thing first. And in our opinion, that right thing is your spending. Now, I will get into those reasons why shortly, but I thought before I would do that, because we live in the information age, it'd be really interesting to see what kind of advice is out there. So to find out, of course, I asked this question to ChatGPT. So I just asked, how much do I need to retire in Canada? And between the emojis and the bolds here, I got some what might seem like useful rules of thumb. So the first being an income replacement rule. So look at your pre-tax income and what you need to spend in retirement is a certain percentage of that. Sure. And then once you know what your income need is, you can apply the 4% rule. Many of you have maybe heard of that before. So if you know that you need to spend $50,000 a year using the 4% rule, that means you would need an investment portfolio of $1.25 million to be able to achieve that retirement spending goal. Easy enough, right? Well, from our perspective, we don't think this is the right way to approach this question. A lot of people, their mind will initially go to retirement. What number do I need to see on a portfolio statement to successfully retire? But we think you're focusing on the wrong things. So before I talk about why spending is more important, let's just talk about these rules of thumb first and why you shouldn't trust them on a surface level. So first is that the first rule of thumb focuses on income, not spending. Income can only give you a clue of what someone's retirement lifestyle could look like. Spending is truly the driver that will tell you how much you need to save for retirement. We can think of two people that work similar jobs and make the same income, but if one lives in a low cost of living city, their home is paid off, maybe their kids are moved out and financially independent, they enjoy simple hobbies like reading and going on hikes, well, their spending and portfolio target is going to look a lot different than one person that lives in a really expensive city with a big home and a bigger mortgage, who's still financially supporting their children and going on multiple vacations. So it would be unfair to say, well, since they make the same income, obviously they have the same spending. So it's really important to make sure you're focusing on the right thing first. Also, your spending while you're working usually looks meaningfully different than what your spending looks like in retirement. So when your income comes in, it can really go to three different buckets: your spending, your savings, or taxes. And once you retire, these can look a lot different. So on the savings part, when you're retired, you're no longer building your portfolio, you're living off of it. So that income need goes away. When it comes to debts, if you're a homeowner and you have a paid off home, well, you no longer have to make that regular mortgage payment. For lifestyle spending, things like commuting to your job, maybe lunches out while you're at work will fall off, but that might get replaced with things like travel, some of those hobbies people outlined, like starting that YouTube channel or golf. But overall, what we can expect is the total spend and the total income need in retirement will be lower. And because of that, the total tax owing will be lower as well. So it's really important to think about not only what is my spending today, but what will my spending look like once I am fully retired? And the second rule of thumb that we got was the infamous 4% rule. And we think, although this is useful to give you a quick number to aim for, it is not nearly comprehensive enough, and it was never truly intended to replace a financial plan. So just to make sure we're all on the same page for what the 4% rule is, this was founded by research done by William Bengen in 1994. And his goal was to identify what sustainable spending number can come from your portfolio going forward. And what he found is that magic number is 4%. If you retire, look at your total portfolio, you can spend 4% of that your first year of retirement, increase that with inflation each year, and be very confident that you're never going to run out of money. Now, that sounds good and all, but it becomes a lot less reliable when you look at the assumptions that this 4% rule is based on. So there are a couple of important flaws to point out for the 4% rule. The first is it's based on US data only over a very specific time period. Other researchers have looked at this and said, okay, what does it look like if we invest in different markets and over different timelines? And the number always seemed to be different. It was never consistently that 4%. And the 4% rule also assumes a 30-year retirement. Now, this was done in 1994. In 2026, people are both retiring earlier and living longer. So planning for a 30-year retirement might not be long enough. You might need to focus on a longer time period, like maybe 40, 45, or even 50 years, depending on when you retire. And lastly, the 4% rule is a little too mechanical, and it's not flexible enough to adapt to everyday life. It ignores important aspects like other sources of income outside of your portfolio and taxes. I'll talk about Canada here. If we have two retirees and one has all of their income in an RRSP or all their portfolios in an RRSP, and the other person has it all in a TFSA, those tax treatments are meaningfully different. So you can't use one rule and say these people have to withdraw the same amount. And then lastly, this rule assumes that everyone will spend the same amount each and every year in retirement, no matter what. We know real life isn't like that. Things come up. A surprise home repair will come up. You might be planning for a big bucket list vacation over the next couple of years. You might be supporting your children. Maybe one of them's getting married soon and you want to give them a bigger than normal gift. Life doesn't happen in a straight line, so it's important to have more of a comprehensive plan in place where you can plan for these surprise or one-time expenses that happen in addition to your regular spending. So although those rules of thumb can be helpful, a lot of them jump to finding that number and they focus on the wrong thing first. It's really important to take the right approach, and that is to start by focusing on your spending. So a couple of questions that might be important to ask yourself is, what do I want my retirement to look like? Am I going on multiple vacations a year? Am I getting that golf membership and paying for lessons to fix my slice? Or am I spending more time at home, maybe running errands during the week, spending time with friends and family, maybe playing board games as your night out? Depending on that retirement lifestyle that you desire, that will lead to identifying the level of spending that will support that lifestyle. So once you know the spending you have in mind, then you can look at the portfolio and spending amount that will support that. And then unlike the 4% rule, we're not going to ignore other income sources. It's important to take a holistic view and look at every single retirement income source you'll get. And then from there, you can determine how much of my desired spending is actually going to come from my investment portfolio. So, just to attach some numbers and give you examples of what different savings targets look like based on your desired spending and retirement lifestyle, this is a chart from Money Sense that they posted in an article a couple of years ago. And the whole idea is just knowing what you want to spend. So, for the example, they used a 28-year-old couple who plan to retire at 65. And other than their portfolio, their only income sources were the government pensions Phil's going to talk about, CPP and OAS. And for a couple that will enjoy a simple, no frills type of lifestyle and would be happy living off 24,000 a year, well, good news for them, CPP and OAS will achieve that goal for them. So they really don't need additional savings beyond that. Now, on the flip side, if people want to spend more in retirement, maybe the ability to gift more, travel more, live more in the deluxe spending range, if you want to spend 100,000 years or more, that's when that portfolio need really increases. So for this couple who only have government pensions, if they want to spend more than $100,000 a year, they absolutely need to save. And in that case, the target might be $1.75 million or more. So the whole idea here is not to focus on these numbers exactly, but it's just the concept of knowing what you want to spend in retirement, and then from there working backwards to find that portfolio size that will support it. Now, I've talked a lot about spending, and it's really important to know where your money is going today and what retirement spending will look like in the future. So there are a couple of different methods you can use to track your spending. There's a bunch of budgeting apps out there. I know it was a sad day for a bunch of Canadians when Mint shut down out of nowhere, but there are other ones you can use to track your spending. A lot of the bank apps also can track your spending and have things worked into their app to give you an idea of what your regular spend looks like. And then there's also the good old spreadsheet, and that's something we like to use here at PWL. So what I have on the screen here is an example of a budget tracker that we will send new clients and existing clients before building and updating their financial plan. And we find this is really valuable because it helps you bring all of your spending into one place. You can take a high level view at your statements over the last year or so, see what that spending looks like, and then also add in some desired spending numbers for things like vacations, home renovation, decor, that kind of thing. And this can be used as a really helpful baseline for us to build a financial plan and make sure what we're projecting is based on the reality you want to live, not just assumptions and simple rules of thumb. And I know from talking to the marketing team, they are working on an expense and budgeting tracker right now that they will make free and available to the public shortly. So make sure to stay tuned for that. So just to summarize this section, rules of thumb are out there. It's fair to know, but they definitely have their limitations. The right starting point is knowing your desired retirement spending and desired retirement lifestyle, and then finding your portfolio number from there. And you want to make sure you're taking a holistic view, looking at all different types of retirement incomes you may have, because there's a good chance some of your desired spending will come from other sources. It doesn't need to come 100% from your portfolio. And one of those pensions that Canadians will have available to them are the government ones, CPP and OAS. And Phil's going to talk about those a little more in depth right now. Over to you, Phil.
Thank you very much. I'm just monitoring the chat here, and we're getting comments on, could anybody really live off of $24,000 a year in retirement? And you're probably right. That might be a little bit low of a number. Again, that chart is from a few years ago. I think really the big point is just that the idea is that it's your spending that's going to drive the amount of money that you need to save, rather than picking some targeted income and basing it off of that. And so that's really the big point behind that chart is you could, in theory, maybe live off of Canada Pension Plan and old age security only and not save for retirement at all. That's just going to dictate, obviously, the amount that you're able to spend. If you want to spend more, then that's going to require a portfolio of a certain size to sustain that lifestyle. And I see that people are posting amounts and links to Canada Pension Plan and old age security, which is fantastic because that's a perfect segue into what we're going to talk about here. So Canada Pension Plan and old age security are two benefits that are going to be provided to Canadians in retirement. And I want to break these down for you. But as a quick check-in and maybe a bit of a trivia question for our audience, let's see what you know already about the Canada Pension Plan. So my question for the group is, how is your Canada Pension Plan benefit determined? Is it based on your residency? Is it based on your contributions into it? Or is it based on the size of your investment portfolio? There we go.
No tricking them today.
Everybody. Oh, somebody did put your resident. Okay, so we got a couple in the other one. Most people are piling into the correct answer, which is your contributions to it throughout your working career. And so, again, both of these benefits are going to act as foundational pillars of income in retirement. They provide guaranteed, defined benefits that are going to increase every year as inflation goes up over time. And so the reason that we think that, that I think that these are so important is because decades ago, it was much more common for employers to provide their employees with defined benefit pension plans for retirement. 40, 50 years ago, we didn't necessarily have to think about saving for retirement in the same way that we do now, because the reality is that defined benefit pensions from an employer are much less common now than they were historically. And so the fact that these are defined benefit pensions with a cost of living adjustment that's going to protect you against inflation over time means that these are really important when it comes to your retirement planning. And so ensuring that we understand how they work and that we're using them properly is going to be super important. And so let's start with Canada Pension Plan and give a quick overview of how this works. And I see, again, people are posting links in the chat to even the source that I'm referencing here. So Canada Pension Plan is, again, based on your contributions to it. The amount that you will receive is based on your contributions to it throughout your working career. The maximum monthly benefit at the quote-unquote normal retirement date of age 65 is just over $1,500 a month. Now, you can apply to receive this benefit earlier than age 65. You can take it as early as age 60, or you have the option to defer it past age 65 to as late as age 70 is the latest age that you can take it. If you apply for the benefit before age 65, the amount that you will receive is reduced by 0.6% per month that you take it before age 65. So let's say, for example, you apply for it at age 60. That's a 36% reduction in your Canada Pension Plan benefit compared to taking it at age 65. If you defer it, the benefit will actually increase by 0.7% for each month that you defer it past age 65. And so if you apply for it at age 70, that's a 42% increase above what you would expect to receive compared to applying for it at age 65. And as I mentioned already, the Canada Pension Plan payments are increased annually with inflation. So one time per year, they increase based on the consumer price index. If you are interested in finding out how much you yourself have contributed to Canada Pension Plan in the past and how much you might expect to receive for your benefit in the future, you can actually get your own statement of historical contributions off of the Government of Canada's website. And so I would highly recommend, if you just Google statement of contributions to the Canada Pension Plan, it will take you here and you can download your statement. And if you're interested, you can actually use our free and publicly available Canada Pension Plan calculator that our research department built, where you can actually go and plug in all of your historical data. You can also put in your current annual income and your expected retirement date. and the calculator will actually help you determine your benefit in the future. And so, just as a couple of quick examples, the example that I've put in here is we have someone who's 58 years old, expecting to retire at age 60. They've been contributing to CPP historically. We can see that the projected benefit for them is just over $1,600 at age 65. If they were to apply for it right away at age 60, it would reduce the benefit to just over $1,000 a month. So it's about a $600 per month difference taking it at age 60 versus 65. And if this person, based on the historical data that I've entered, were to defer their benefit all the way to age 70, it would increase the benefit to $2,347 per month. So we're talking about a pretty meaningful difference in guaranteed income here. Age 60 is just over $1,000. Age 70, it's over $2,300. So a pretty meaningful example. I see Bruce saying, can we use your calculator for couples? So you would do this. It's all based on your individual contributions, but you could obviously both, separately put in your data and see what your individual CPP benefits would be. So Bruce, highly recommend checking it out. All right, let's keep going. Thank you, Paige, for the heads up about the technical issue with Zoom. All good. I think everybody can still hear me and see me. So that's Canada Pension Plan. Check out our calculator, figure out what your benefits are going to be, and consider the impact of the different ages that you may consider applying for those benefits. Let's talk about old age security. So rather than your old age security benefit being based on any contributions that you've made, this benefit, the amount that you will receive, is based on the number of years that you've been a Canadian resident after age 18. The earliest that you can apply for this one is age 65, but you also have the option to defer this one until as late as age 70. And similar to CPP, deferring it does come with an increased benefit where old age security will increase by 0.6% per month for each month that you defer it past age 65. As of this year, the maximum benefit that you'd receive at age 65 is $742.31 per month from ages 65 until 74. And then starting at age 75, it increases by 10% up to $816. Now, this benefit also is income tested. So there is the potential that if you're retired and you've got a high individual income in retirement, that some of this benefit may start getting clawed back. And as of this year, the clawback begins if your income is over $95,323 for the year. And like CPP, this one increases with inflation, but whereas CPP increases once per year, old age security payments actually increase quarterly with inflation. And so the conclusions with these two benefits is that, again, as Joel mentioned earlier, people are living longer and longer. The standard ages to use for life expectancy in Canada for financial planning are ages 95 and 97 for men and women nowadays. And so longer life expectancy does make deferring these benefits look very attractive to get the higher amounts for a longer period of time. If you do retire before you start collecting these benefits, what you would do is self-fund those initial years of your retirement from your investments and then replace the withdrawals that you're taking from your investments later on with those higher Canada Pension Plan and old age security benefits. And again, as someone who has done hundreds of financial plans at this point, I tend to find that the larger benefit indexed to inflation tends to provide some pretty significant protection to your retirement, especially in the later years. So hopefully this has shed some light or maybe provided some new information for those that were less familiar with these plans. Let's shift gears now and talk about some additional risks to your retirement that you need to consider.
Awesome. Thanks, Phil. And yeah, understanding those government pensions, CPP and OAS, is so important because they are foundational to every Canadian's retirement planning. But now let's shift gears and talk about some risks that could impact your retirement. So before I get into the risk side in mind, I'm going to talk about two, why they impact you, why they matter, and then strategies to help combat them. I'd love to hear from the crowd. as you are either entering or thinking about retirement, what big questions or concerns do you have about entering this stage?
While people are answering that, David asked a great question in the chat. He says, if I understand this correctly, OAS would begin to be clawed back as a couple if we are collecting greater than 95K each. And that is correct. So the clawback is $95,000 individually, your taxable income in retirement.
Awesome. Yeah. And we're getting some great responses from the chat here. Inflation risk, market volatility. Did I start saving early enough? Health, longevity, taxes, health coverage, low returns. Yeah, these are all really important and valid points to consider when thinking about your retirement. Really great responses. So I saw this mentioned a couple of times, and the first risk that I'm going to talk about is inflation risk. So in a nutshell, inflation is the measure of prices increasing over time. And why this is important is because when you're retired, you're going to want to make sure that you can maintain what is called your purchasing power, making sure that you can still buy tomorrow what you can buy today. So one example we have here just looks at the cost of a cup of coffee. I don't know about you guys. I can't live without coffee. So no matter what the price is, I will be paying it. So for this example, in 2025, let's say a large cup of coffee is $3. If inflation is around 2% a year, we would obviously expect that the price for the same cup of coffee to increase. So by 2035, it would go up by 70 cents. And then by 2045, 20 years later, that price of the same coffee would be up to $4.50. And of course, inflation doesn't just impact things like coffee, it impacts your housing costs, costs at the grocery store, activities, hobbies, and travel. Inflation really impacts anything you could spend money on in retirement. So it's really important to know that it exists. And then because we know it's going to be there, we have to think about what strategies and ideas we can put in place to help combat inflation. So the first idea, and Phil talked about this, is deferring your government pensions. In 2026, a lot of the classic defined benefit pension plans have gone away. Unless you're a teacher, a government worker, or you work in healthcare, you more than likely don't have a defined benefit pension. The only source of income that you will have otherwise that's guaranteed and increases with inflation each and every year are those government pensions, CPP and OAS. So if you have the means to do so, it can be very valuable to defer those benefits beyond their default start dates because that increases your floor of retirement spending for you. And having that bigger bucket of guaranteed income will help hedge against inflation risk. And then with the money that's in your portfolio that you plan to draw from throughout retirement, it's really important that you are putting that money to work for you and you are investing in the stock market. So just to give you an idea, stocks have greatly outpaced inflation over time. This chart looks from 1985 to 2024. And over this period with Canadian inflation, things have gotten 3 times more expensive. So if in 1985, instead of investing, you maybe just stuck your money underneath your mattress, well, when you pulled that money out in 2024, you could only buy a third of what you could buy before. So it's really important to invest in things. So for this example, if you invest in a world equity portfolio over that same time period, not only did you match inflation and triple your money, you did much more than that over this time period. That dollar grew into 54 times bigger than it was before. So that is why it's very important to know if this money's for the long term, I should invest it to make sure it keeps track and exceeds inflation. Now, one thought you might have when I say this is, okay, yeah, I know inflation is a risk, but isn't investing also risky as well? And I'll just ask Phil to go back to that one slide shortly. And you'd be absolutely right. Investing does have risk, and that risk is volatility over the short term. It's easy to look at this chart and say $1 turns into $54 over this time period. But a lot happened between now and then. There were a lot of ups and downs in the markets, things like the dot-com crash, the global financial crisis, the COVID-19 pandemic. This doesn't include all of the news headlines we've had lately surrounding geopolitical issues and tariffs. So there's absolutely risk in investing, and that risk is short-term volatility. So that brings us to the next risk that I want to talk about, and that is market downturns. So we know for being a long-term investor, we all want that large investment return, but to get that, we're going to need to withstand those bumps in market volatility along the way. And when we look at a lot of retirement plans and projections, people love to talk about the average or expected rate of return. But one thing that's really interesting looking at historical data is that average that people quote doesn't come by all that often. So this chart here looks at historical US data over the last 100 years because that's one of the few markets we have that much data for. And over that time period, the average annualized return before fees since 1926 has been about 10%. But believe it or not, over that time period, there was only 7 years where the average annual return was even close to that range. There were other years where returns were much stronger and years where returns were much lower. So it's important to understand this as a long-term investor that it's not always a smooth ride to achieve that expected average return. There will be ups and downs along the way. So when it comes to planning for market risk and inflation risk, it's really important to find the right balance between the two. If you are so concerned with short-term volatility and don't want to ever see your account statement balance drop, then you would be leaving your money in cash. But if you were to do that, then we would know inflation would erode your money over time. In the same breath, if you wanted to beat inflation and invest it aggressively, perhaps too aggressively, something more than what you're comfortable with, well, that could lead with a lot of swings in market volatility along the way. So to make sure you can combat inflation, grow your money, and ensure that your portfolio grows over time, it's really important to find the right balance between the two. A risk that you're comfortable with and a portfolio you can stick with through all market environments. So to help you manage market downturns, there's a couple of important things to keep in mind. One is to plan and prepare for market volatility. As I outlined there, it's pretty rare we see the average investment return on any given year. We know that it will be much different than what's expected. So it's important as an investor behaviorally to be emotionally prepared for that. So it's not a matter of if the market return is different than what we expect. It's when that you know you're okay and that you're not going to panic by reading market headlines and seeing your portfolio values drastically change. The next is having a financial plan in place with those expected returns, but then stress testing it. So here at PWL, we like to build a baseline financial plan that includes someone spending, their expected CPP and OAS, and we will see what a successful financial plan looks like with their desired retirement date. But then once we have that, we like to run their portfolios through different market volatility simulations. Maybe a lot of you have heard of Monte Carlo simulations before. So we would run 1,000 different scenarios where investment returns vary each and every year. And the reason that we do this is to check to see how sustainable and how bulletproof the financial plan we put in place is. So we think it's really important to not only look at your plan through rose-colored glasses and expected returns, but also consider what happens if markets do worse than expected. And that way, if you know you have a financial plan that's healthy in down markets, when markets go down, that might cause less panic for you when you're looking at your portfolio statements. And the last point I want to make is that it's really important to be flexible with the plan that you put in place. One really interesting and important topic is the idea of dynamic spending. So that is, we all have our fixed expenses that we can't avoid: housing, food, bills. But if we do have some discretionary spending like vacations or expensive hobbies, if we can be dynamic with those non-essential expenses, especially when markets are down, that can help lead to meaningfully better planning outcomes. And the same is true if the markets do better than expected. If you put a plan in place and markets continue to do well like they've done over the last couple of years, with dynamic spending, that would allow you to spend more than what you initially had planned. So it's really important to build a layer of flexibility into your financial plan. So just to wrap up this section, inflation and market volatility are risks that will impact your retirement, but they're risks that you can't entirely avoid. It's really important to make sure your long-term money is investing and growing, at least keeping pace with inflation, so you can maintain your purchasing power. And it's important to remember that planning matters. It's really important to have a good, comprehensive plan in place that includes your desired spending, CPP and OAS, your desired retirement date, and then also things like stress test and market volatility to make sure you're still fine going forward, especially if market returns aren't as good as they have been in the past. So now to keep talking about some planning ideas that we have in mind, I know Phil's prepared a couple of examples to go over when it comes to how to actually spend down your portfolio when you're in retirement. Over to you, Phil.
Awesome. Thanks, Joel. So, yeah, for this last section, I know when we did a webinar, similar content to this a couple of years ago, one of the common pieces of feedback that we got from people was, okay, this is all great when I'm thinking about, how much I might need to save and I'm building my nest egg. But when it comes to actually turning my savings into income, a phrase or a word that a lot of people use is decumulation. How do I actually think about doing that? And are there any considerations or strategies there that I should be aware of? And I actually thought that the best way to talk about this would be to do a bit of a case study or a sample financial plan to show you an example of the impact that some of these decumulation or order of withdrawal strategies can have. And so the key idea here is that the success of your retirement plan can be meaningfully impacted by the order of withdrawals from your various investment accounts, combined with the age at which you apply to receive Canada Pension Plan and old age security. So let's check out an example of what this could look like in practice. These are not real clients. This is a fake and sample financial plan. But we've got our clients here, John and Jane. They both just retired at age 60, and they've told us that their goal is to spend $8,500 per month after tax for life, and they want to increase that number with inflation over time. Let's pretend they've got 1.4 million in combined RRSPs, 360,000 in combined TFSAs. They have a house valued at $1 million that's paid off that they're never planning on selling to use to fund their retirement. They're both entitled to receive 85% of the Canada Pension Plan benefit, and they're both entitled to receive 100% of old age security. So the question is, okay, are these guys able to achieve these goals given their savings, given, the spending number that they've determined is what they need to maintain their lifestyle? Let's check out what some of the results are of this plan, because we're going to take their numbers, we're going to put it into our financial planning software, and we're going to do a whole bunch of math for them, and we're going to run some stress tests like Joel talked about to determine whether we have a successful plan or not. And so let's look at a couple of different strategies that these folks might consider implementing to actually fund their retirement. We're going to do a bit of a comparison here. So strategy number one is that they apply for their Canada Pension Plan and old age security benefits as soon as they can get them. So CPP at age 60, old age security at age 65. They decide, you know what, we don't want to pay taxes on our withdrawals. And so we want to, we're going to take from the TFSA first to minimize the taxes that we pay up front. And once the TFSA is depleted, at that point, we'll start drawing from our RSPs and RIFs. And so when we look at their plan, this is a report that we can generate in our financial planning software that actually shows their order of withdrawals or their retirement paycheck over time. So we can see on the left side of the screen, the early years in retirement were primarily funded from TFSA and from CPP. And then later on, we start incorporating RSPs and old age security. Martin asked, what investment mix are we assuming in these scenarios? I think it's an 80-20 mix. So to Joel's point about we need to have stocks in our portfolio to stay out ahead of inflation, we're assuming that these folks are invested 80% in stocks and 20% in bonds. Great question. And somebody else asked, is OAS only available at 65? Yes. Hopefully I didn't say OAS at 60. They would be applying for OAS at age 65 in this scenario. So to determine whether this plan is successful, we actually give these folks a retirement score. Our software runs all the math and it tells us, are we 100% funded, indicating that we've got enough money coming in to fund our goals? Are we 80% funded, which would indicate that there's a shortfall in our plan and we need to make an adjustment somewhere? Or are we more than 100% funded, meaning John and Jane can actually spend more money on average than what we've projected? And what we can see is that their retirement score is 133%. Congratulations, John and Jane. You are able to achieve the retirement goals that you have articulated. We can also see at Jane's age 97 that they're projected to leave a legacy of just over $6 million after tax. Now, that's the combined value of their house, which we're assuming is going to continue appreciating over time, as well as any investments that they might have left over. So this is a successful plan. We can see that John and Jane are in great shape. The question is, using financial planning, can we make this plan any better? Oh, one other quick thing. Sorry, I'm skipping ahead. We also want to stress test their plan like Joel talked about earlier. So we run our volatility simulations. We run 1,000 simulations with good returns, bad returns, everything in between. And we can see that their plan is successful in 736 out of 1,000 simulations. So there's about, let's call it a 75% chance based on expected market returns in the future that John and Jane are going to be able to achieve their spending goals, a 25% chance that they may need to make some type of adjustment in the future if market returns are poor. So overall, this initial strategy looks pretty good, a fairly healthy and successful retirement plan. But the question is, if we do some financial planning here for John and Jane, can we make their plan even better? And so let's compare this to strategy number two. Strategy number two is instead of applying for their government benefits as early as they can get them, let's have them defer those benefits until age 70. And rather than focusing on withdrawing from the TFSAs first, let's actually have them prioritize RRSP withdrawals first and then leave the TFSA towards the end. And so this time their retirement paycheck looks a little bit different. We can see our government benefits, the bars are much larger compared to the first chart because they're getting those deferral benefits. And they're also pulling money out of their RRSPs from age 60 to 70 when they don't have Canada Pension Plan or old age security coming in. This is allowing them to get some money out of their RRSPs at lower tax rates. And so just by changing the order of withdrawals, just by changing when they've applied for their Canada Pension Plan and old age security, we've increased their retirement score by 16%. We've given them the ability, if they want to be able to spend even more money throughout the plan. And we've also added $1.9 million to their legacy. I don't know about you, Joel, but as a financial planner, I get really excited about the prospect of being able to add $1.9 million in value to my clients just through some financial planning. If we also run their stress test, we can see that this other strategy makes a meaningful improvement when we factor in market volatility. Their success rate has gone up to 853 out of 1,000 successful simulations. Meaning, not only have we given them the ability to spend more, not only have we put more money back into their pocket, we've done a better job protecting them against those risks that Joel highlighted, inflation and market volatility. And so this is a great example of the impact that the order of withdrawals can have on your plan, and hopefully highlights just how meaningful having a solid financial plan in place, how valuable that can be. The last thing that these guys may want to consider when it comes to decumulation is, rather than articulate the goal as $8,500 per month in spending, Joel talked earlier about how, that rule of thumb, maybe that's one way that you can run a financial plan, assuming that you're going to spend the same amount every single year for life and just increase that with inflation. But I know in my experience that I often get feedback of, hey, you know what? We'd love to see a financial plan where we can spend more earlier in retirement while we're younger, healthier, we're going to be more active, we're going to do more travel. Maybe we have some hopes and dreams, some things on our bucket list that we're hoping to cross off earlier in retirement. And so one other strategy to consider when it comes to building out your financial plan is doing tiered spending. Rather than assuming $8,500 per month, you could do something like higher spending for the first, 15 years until age 75, lower spending in the middle, and then maybe increasing the spending again later in life to account for potentially increased healthcare costs. This could end up leading to a higher, to a more enjoyable retirement. And as long as you're running those same stress tests and getting similar outcomes that show that you can achieve this level of spending, this might be a better way to design your retirement spending goals rather than just taking a flat number and assuming that for life. And so, in conclusion, the strategies that we've implemented here, again, are deferring the government benefits. These are going to provide protection against volatility and inflation in the future. We prioritize doing RRSP withdrawals during the low tax window while we're deferring Canada Pension Plan and old age security. And then also implementing a tiered spending strategy could lead to a more enjoyable retirement where you're spending more early and decreasing spending, later on in the plan. So hopefully those are some ideas to think about when it comes to decumulation or turning your nest egg into an income stream in retirement. The last thing that we wanted to share was just a quick recap of really the big points to take away from this webinar. Point number one is that your spending goal for retirement will determine how much you need to save. So start with, what am I spending today? And use that as a proxy or a comparison for what you may want to spend in the future. That's going to help you figure out how much you need to save for your retirement. Canada Pension Plan and Old Age Security will provide guaranteed inflation protected income. And so understanding these benefits and knowing when to apply for them is also something to be aware of. Inflation and volatility are risks that should be accounted for in your plan. And so you need to include inflation in your projections, and ideally you're stress testing your plan using Monte Carlo simulations or volatility analysis to account for variable returns from the markets. And then finally, the order of withdrawal matters. And so having a financial plan to help you figure this out is also super important. Joel, do you want to share the resources for the folks to check out?
Awesome. Absolutely. Yeah. Really great points, Phil. And before we go and wrap up here, we just wanted to share a few extra resources that our great audience here might find helpful. So the first is our finding and funding a good life paper. So this was put together by our now CIO, Ben Felix, back in May 2022. And what this focuses on are a lot of the non-financial aspects of making financial decisions and retirement spending decisions. So if you are one that maybe struggled with that initial question of how would I spend my time, if I retired tomorrow, or if you just want to make sure that what you're spending on in retirement is actually filling up your cup, I highly recommend checking out Finding and Funding a Good Life. It was transformational with how I think about financial planning and decision making.
Yeah, agreed.
And then also, PWL has put together a free retirement planning guide for Canadians. So if you haven't checked it out already, I highly recommend giving it a download. It covers a lot of the topics that we covered today and more. So if you liked what you learned, but would like to dive a little bit more into things like the 4% rule and those government benefits and how they work, please download the retirement planning guide. And then lastly, we gave you a lot of information today, and hopefully a lot of this you can take on your own and implement. But if you listen to this and thought, hey, this type of planning is something that I may find helpful, please reach out to us and our team. Cam will share the link to our contact page on our website. We have an excellent team member named Paige who will be in contact with you, have an initial conversation to learn about your goals and ultimately what you're looking for. And then from there, she can help push you in the right direction to make sure you're getting the financial planning help you deserve. And with that, that's everything we had planned for you today. Look at us for timing, 12:59 on the dot. I just want to say thank you, everyone, for coming and participating in the chat and answering the questions. It really makes this type of webinar a lot of fun for me and Phil to present. So just before we wrap up here, I was wondering if we had any last questions
Yeah,
from the audience.
I'm okay to run over maybe a minute or two. We got the update that Canada has scored 5 goals. I think they're up 5-0, so that's good. I was trying to keep an eye on the chat and there were a lot of questions popping up here. So a few people asked, will this presentation be accessible afterwards? The answer is yes. It will go up on the PWL YouTube channel, so look out for that. Is the planning software you use available for free? So no, we're showing you the software that we use here at PWL with our clients. Now, if you go to PWL's research page where the Canada Pension Plan calculator was that I showed you, there also is some free retirement planning software that you can use on there as well. It's going to look a little bit different. I don't think it has the Monte Carlo stress test available on there, but it is if you're more of a DIY person and want to try running some of those projections yourself. We do have that available on the research team's website of tools. So check that out. And Cam just posted the link there if you want to take a look. I don't. I'm trying to scroll up here for any other questions. Do your plans ever include things like annuities or ALDAs to better deal with longevity risk? So we do, yeah, oftentimes if clients are interested in purchasing annuities, we do try to model that in the projections as well. Yes, big fan of annuities and think that they can be very helpful in a lot of situations. Okay, well, I'm scrolling. Hopefully we've answered. Hopefully nobody's leaving without their question getting answered. But again, if you want to chat with us, please do book a call. We'd be happy to chat with you and answer any follow-up questions after that. So we will end here. Thank you very much, everybody, for coming. I hope everybody stays warm out there and enjoys the rest of their week. Thanks, everybody.
Thanks, everyone.